welcome to Moneycontrol. You have tuned into IPO Watch and I'm your host Nickey Mirchandani. We're here to talk about Rajkot-based Gopal Snacks today. It's hitting in the primary market today with a sum of around or expectation of raising around 650 odd crore through an initial public offering. It's adding to the growing list of the regional brands, of course, and the share is expected to, let's say, the share sale is opening on Wednesday, that is today, and will close on March 8. It is priced in the range of around 381 to 401 per share. But to know more about the company's strategy, USP and the financials, we're being joined by Raj Bipinbhai Hadvani, who is the Chief Executive Officer, and Mukesh Kumar Shah, who's the Chief Financial Officer of the company. Well, afternoon there, gentlemen. It's a high-growth company. It may have not tapped the primary market had it not been for the loans, essentially, which have been availed by the company to an extent of 540 odd crore. Large part of the offer is aimed to pay back this loan taken in Feb 2023. Tell us more about this. How do you intend to now further consolidate, or rather go about with the business split after the family dispute that came through? And what kind of debt to equity ratio are you comfortable with in the future?
Yeah, so I'll take this question. So as you rightly said, the proceeds of the IPO will go for repayment of debt, which the promoter has taken in his personal capacity. We in the main company, which is Gopal Snacks Limited, we don't have any borrowings. So everything is, so there is no borrowing, and we are cash positive in the company. So, and from a capex perspective also, we have invested in our facility both in Nagpur and Modasa. Currently we are running at a capacity of 35 to 40%. So we don't need any capex in near future as we are already invested. So our focus is to grow revenue, and currently we are present in almost 10 plus 12 states, and we have a sales team set up already in place, and focus is to grow sales going forward.
Okay, tell us more about the family dispute which took place, which in turn led to the promoter taking up the loan in the personal capacity. What kind of solutions are we looking at, or how is the situation stacking up right now? And going forward, what kind of equations we could be looking in for the shareholders' perspective, because that's also one thing which sometimes weigh down on the stock performance. But going forward, how is the business split also going to be looking like? A bit more detail on that.
Yeah, so 100% stake has been taken from the brother. So there is no holding of brother in the company currently. The company is run by a professional sales team, while the brother has also started his own business, and they are in the similar line. But given the strong brand and our presence in Gujarat for almost more than 2 decades, with a great products and wide range of product portfolio, we have a plan to grow and grow more than the industry estimates.
Okay. So does the brother company also is pretty much in the similar line of business, using in the similar kind of geographies and the similar product base? Is that also the case?
Yeah, they have recently started, and they are in the similar line of products.
In the same area that you're operating in, right?
Yeah, so we are operating in almost 12 states, but last year only started in month of March. So his presence is predominantly in Gujarat.
Okay. So let's talk about your scaling up. How do you intend to scale up going forward in terms of the geographies, in terms of the products? Tell us more about that.
So we are currently into 11 states, and you can see our majority sales comes from Gujarat market. So we are as of now trying to penetrate our chips and western snacks product business deeper into the Gujarat, and outside of the Gujarat we are just present in 25% of the area. So we will deeply penetrate into Maharashtra, Rajasthan, UP, and then we slowly move towards the other states. And we have another plant in Nagpur. So we'll use their capacity to extend business near to the Nagpur area.
Okay, so 75% of your business essentially comes from Gujarat, right? And 25% outside Gujarat. Have I got that right?
75% Gujarat, non-Gujarat 25%.
Okay, so now that you have an in-house competitor within the state region, how are you going to be? What's going to be your strategy to outperform the industry standards, or for that matter, even scale up bigger than the industry size? Because the market size is at around 79,600 as of FY23, and a report suggests that it's likely to see an 11% growth in terms of the CAGR from FY23 to 27. So you think you expect to outperform that number?
See, if I mention about the Gujarat's market, since last 10 years, so many big company came into the market and they have tried to capture Gujarat's market. This is one of them, what we consider. Secondly, we have our strong deeper penetration into our retail segment, and still we see more retailer which our distributor are not tapping. So we'll install systems structures to tap those retailer, and we have our system to penetrate our SKU to our existing distributor.
Sorry, excuse me. Sure. So do you expect to outperform that number, the 11% growth that the industry is expected to?
Yes, we'll definitely beat industrial growth rate.
Okay, let's talk about the sharp jump that has come through in terms of the net margin for the company, especially for FY 2023 at 8.1% versus 1.9% in FY21 and 3.1% in FY22. What explains that? What can be expected going forward?
Yeah, so I'll take this question. So the comparison between FY23 versus FY22, where you see a sharp increase in the margin. So you have to understand the snack industry. Basically there is the grammage plays a critical role. So the quantity of raw material what you give to finished goods, what you give to customers, also play a critical role in margin structure. So in prior to FY22, maybe in till mid FY22, we were offering 5 grammage higher compared to other players, both in Gujarat as well as outside. Typically for our industry or in our business, we sell close to 1 crore a packet a day, and 5 gram of raw material values us rupees 50 lakhs a day, which on an annualized basis it translates to 150 crores a day. During COVID time, we have seen a spike, significant increase in raw material price, particularly palm oil. And the 5 gram out of 30 grams is 20% of the value which we are giving higher compared to other players. So in mid of FY22, we matched the grammage similar to other players, which resulted into a benefit in terms of margin in FY23. In FY24, in month of June, when the raw material prices and again the palm oil prices came down significantly at 80 to 84 range, we have restored the grammage from 20 grammage to 25 grammage, and now we are clocking the similar EBITDA margin at around 13%. So these margins are sustainable even at the current raw material prices.
Sure. Gentlemen, let's also understand the key difference, because I think much of your financials are driven by the cost optimization measures. But help us understand that, Gopal Snacks has clocked in a CAGR of 11% from FY21 to 23, whereas Bikaji clocked in 23%, Pratap Snacks clocked in a growth of 19%. Help us understand why the numbers in terms of the revenue CAGR growth in the last 3 years have been below what other peers have done, at least when it comes to Bikaji and Pratap Snacks.
So revenue in last 1.5 years, we have seen a muted growth. The reason being the family dispute and family split, which kind of created a turbulence or internal differences, and we had an impact in first 2-3 quarters of this 2 quarters of this financial year, last quarter of previous financial year. Now seeing the revenue trend, we are seeing a quarter-on-quarter growth every quarter in FY24. And as Rajbhai mentioned, we will beat the industry growth estimate in coming years.
When you say coming years, are we looking at the next 3 years period or by FY25? Any ballpark understanding on that? 11% is the industry growth rate expectation. So how much do you expect to scale up by?
So it will be a double-digit growth, definitely better than industry.
Okay. I'm not going to push you more than that, but let's talk about the net profitability. The growth has been way higher as compared to that of the other peers. 130% as compared to 19% and 20%. Also, the scale comes at play here. Help us understand going forward what kind of cost optimization measures can one look at? Because now that sales are expected to pick up in a bigger way, the family dispute is out of the way. Do you think that will have a bearing on the operational performance as you scale up? And does, by virtue of that, you might see a top line growth, but bottom line growth might just slow down?
So definitely the top line growth will help us in increasing our EBITDA and PAT in absolute terms. But from a margin perspective, we are currently a regional player. While our presence is there in other states as well, we will be focusing in a big way in advertisement and promotional cost. So the extra bit of cost we will be planning to spend it in a advertisement cost. And in terms of cost optimization, we have plant in Nagpur and Modasa, where the capacity utilization is close to 35 to 40%. And in Nagpur, the capacity utilization is only 15 to 20%. And we have already incurred overhead cost there. So with the increase in capacity when the sale grows, we will see a lot of cost optimization because the fixed overhead will remain fixed. And the variable, the entire incremental gross margin will get into EBITDA.
So what kind of gross margin can one now look at? Because your gross margin stood at around roughly, I'm talking about the TTM basis, 29.9%, and this is comparable to 32% odd both by Bikaji and Pratap Snacks. So how do you intend to further optimize your scalability in a way where your margins also get lifted?
So margin, basically we are into 5 rupees and 10. So our major revenue comes from 5 rupees SKU. And so from a margin perspective, the perspective is that the gross margin will remain in the range of 28 to 29%. Because we provide products which are of value for money. And definitely in case there is a significant increase in raw material prices, etc., we do make a changes in the grammage similar to the industry move, but we will try to maintain gross profit margin at a given percentage, which is currently at 28-29%.
Right. The company also plans to introduce in higher price grammage SKUs, as you just mentioned, as there could be increase in the acceptance of such packs due to softening of inflation, right? Provide more guidance on this. What do you intend to do further?
So we have all sort of packages, right from 5 rupees SKU, 10 rupees and more than 10 rupees into 100 grams, 200 grams, etc. And currently our 98% of sales comes from general trade. We are focusing into modern trade, e-commerce, our online sales, etc. Definitely there will be with all these sectors catching up, our mix between 5 rupees and the bigger pack will tend to change. From 75% currently, we expect that this move will be between 60 to 40%. So 60% coming from 5 rupees SKU and 40% from the larger packs.
Okay. So incrementally, do you target to have more revenues coming in on account of the higher price grammage SKUs?
So higher price grammage, because so this will be an industry move. While 75% of our revenue is coming from 5 rupees grammage, we have products in wafers, etc., where we sell product only at 10 rupees SKU. For example, our Christos wafer, which is only at 10 rupees SKUs and higher pack. We are seeing traction of wafers in the current market, where we have grown this product almost 35 to 40% compared to previous year. So as the growth in wafer comes, there will be a shift of mix between 5 rupees to 10 rupees.
All right. And by when this is expected?
So it's a journey. So it is not going to be on a year one. It is a journey. It will take at least 3 to 4 years to change the mix from 75% to maybe 55-60%. 5 rupees SKU, I'm saying.
What is going to be your cutting edge right now? Let's just say, what is your cutting edge now that you are operating in a highly competitive industry, competing with some of the bigger and the reputed names like Bikaji and Haldiram, and now you also have an in-house competition within the same markets that you operate. What's your USP here?
So I will answer that question. So
Sure.
we first USP is our deeper penetration. See, if you in Gujarat we have reached in each and every village, and in each and every village we have reached to each and every shops. So that our core strength. Secondly, we don't have any super stockist or CNF agent in between. So we directly sell to a distributor, and our distributor directly sell to a retailer. Third, we have track record of last 7 years of our retailers. For an example, any Nukkad, there is one shops and they are selling our products. We have their track record of 7 years, that in which month they have sold how many products in how many SKUs. Everything we have our data. So we have our backend team which do their survey on this data, and they come up with the insights, and we move according to that insight. Third, we have our portfolio. If I come to the outside of the Gujarat, we have 15-20 products, which products are not at all closer to any competitor. For an example, our gathia products, few chips product, few snack pellets product, which are not available in our competitors' portfolio, and which help us to penetrate into any retail shops. We do them sampling. So after sampling, they can understand our product. They liked our product because we believe in quality, and we always try to give best in world class quality in our products, so that our end customer is happy, and if they are happy, they will demand our products. That's what we are building.
Sure. But gentlemen, I think I'm just going to squeeze in one last question. A majority of the products are sold via general trade channel, right? However, the company is expanding presence in the modern trade and e-commerce too, aiding better brand awareness. What kind of cost are you anticipating for this initiative? What kind of incremental sales are you looking from this initiative? Provide more color on that.
So since last few months only, we have started with national level modern trade chains, and we see very good demand from that chain as well, because these days so many people are going to modern chain compared to general trade, and they know our brand, they know our products, and we offer in a very good price compared to other competitor available in those modern chains. So yes, we are getting very good response from those chain. Secondly, on online platform, we have already we are into 3 or 4 online platform, and we have a dedicated team who is working to come in all the online platforms, and we have few products for that online platform as well, which can benefit us and the platform as well.
Okay, gentlemen, 30 seconds on this. You said that the industry growth, you're going to be outperforming that. In the previous 3 years, it was a bit muted because of the internal reasons like the dispute. But going forward, you have now that is done and dusted. You expect the growth to be higher than the industry. Just give us 3 reasons quickly in 30 seconds as to why do you think you'd be outperforming.
First of all, we have built world-class team, because without any good team, you cannot do your work. Alone, only company cannot do your work. Secondly, we have our product portfolio, which are completely different. Like I have mentioned, 15 products, which can able to generate sales from our tertiary market, and we have higher grammage to our competitors in non-Gujarat state, so which help our end customer to have a tertiary more and more.
All right, sir, we're just going to leave it at that. And thank you so much for taking out the time and having this conversation right here with us.
Thank you.
All right, that was the management of the company. It is a high growth oriented company that we're talking about, has strategically expanded in the focus states in the ethnic category by leveraging its existing distribution network. Of course, from the interview, you could gather that the muted growth in top line for the last 3 years has been due to the family dispute. But in the coming 3 years, now that the issue is past, the company, they're only expected to do a number which is upward of 11%. That is higher than the industry standard growth. The valuation of this company right now is lower as compared to the peers. But if you talk about the net profitability of the company, because of their cost optimization measures in the past, has been rather encouraging. But that's all that we have in this edition of Trade. Thank you so much for tuning in.